October 7th, and we are live from Bloomberg's World Headquarters. Good morning, everyone. I'm Benny Liu. Coming up this morning, what is at stake for investors as Congress looks to regulate the derivatives market? We're going to talk to Bill O'Neill, who covers commodity futures for Logic Advisors. Plus, that company that Warren Buffett likes, you know, the one that's going to go public, well, it's Verisk Analytics, which supplies data to insurance companies. And in the next hour, we're going to be talking to the company's CEO. In the meantime, I want to get you caught up on how the markets are trading right now. Aside from the fact that gold hitting a record, equity futures at this moment indicating a slightly higher open. Dow futures up, right, as you can see on the board, by about 11 points. For treasuries, they are also gaining ground, not a whole lot, but more for the 10-year than for the 2-year. Well, as I mentioned, gold prices hitting a record for a second straight day, trading close to $1,050 an ounce. And for the latest, we get to the markets desk and to Bloomberg's Adam Johnson. Adam.
Hey, Betty. Yeah, an absolutely huge move in gold. It's caught everybody off guards. I mean, you look at where economists thought gold was going to be just 1 week ago, about 1025 through 2011. Obviously, we blew through that over the past couple of days, now trading close to 1050. It's quite a move, but I want to show you what it really all boils down to. It's the weak dollar. Take a look at this. Quite a chart. As dollar falls, gold rises. We went back, looked at the relationship between the two starting in 1995, and look at this. You had the dollar rising, all right? Gold falling. Well, then in about 2000, the reverse started happening. The dollar started falling, and look at gold. Secular move just took off. Unless there be any doubt about whether this is a long-term, short-term relationship, even in the short term, when the dollar started to spike about a year ago, look what happened to gold. And of course, now vice versa, the dollar falling, gold rising. That's really the move. That's what's happening. So what's killing the dollar? Well, obviously, the record deficit, that's part of it. And then you read the article that we covered in the Independent of London newspaper that came out on Monday, where they were talking about a potential meeting at the IMF of various countries saying they don't want to use the dollar anymore as the means of pricing oil. Well, all of those ministers have denied that rumor. They said, no, it's not true, in spite of the fact that it was published in the newspaper. But, you know, you get that kind of mindset that starts playing into people and on trading desks around the world. It starts pushing the dollar down. That's what's happening, and that's obviously what's driving gold. Betty. Okay, thank you so much, Adam. And the dollar, in fact, playing into this next company that is releasing earnings right now, Monsanto, saying that their fourth quarter ongoing earnings is coming in at 2 cents a share. That's slightly better than the estimate for 1 cent a share. Also reaffirming their forecast for the free cash flow for 2010. Again, they're saying that their EPS is coming in at 2 cents per share. Sales, by the way, at $1.9 billion. And again, reaffirming their forecast. So we'll have more on Monsanto. You can see that stock is up by 0.6% right now. Well, earnings, speaking of that, as well as IPOs, are in focus at the New York Stock Exchange. And Suzanne O'Halloran following those stories. Suzanne?
Well, thanks, Betty. Along with Monsanto, which you just detailed, we have earnings from Yum Brands, the owner of Kentucky Fried Chicken and Taco Bell. Late last night, they posted earnings that came in better than expected, and they also boosted their full-year forecast. The company is getting a benefit from lower commodity prices, and they're also expanding aggressively in China. Next to the U.S., China is their second largest market, so keep an eye on that stock. It's up about 1% today. Also, we've got a lot of retail news. Family Dollar out with earnings as well. Those coming in a little bit better than expected as well by about 1 cent. That stock is up over 2%, as you can see right now. Their forecast pretty much in line with expectations. And another positive note for Family Dollar, their same-store sales rose 1%. That is a modest increase, but Betty, with all of the retailers posting sales declines, this is obviously a positive for a lot of investors. And I want to mention warehouse chain Costco as well. Those numbers not as good. They are actually getting hurt from lower gasoline prices. Profits fell, but as you can see, the stock is up about 2% today. Their same-store sales also rose a modest 1%. You mentioned the Verisk IPO. We also have a big IPO here. Banco Santander's Brazilian bank unit, Betty, raising $8 billion in an IPO that will begin trading here at the big board today. Certainly a big deal after that big Olympic win for the country. Betty, back to you.
Okay, thank you so much, Suzanne. Well, it is D-Day for derivatives as Congress begins debating how to regulate the industry that is blamed for causing the financial crisis. We're going to tell you who will get slammed by the new rules and who's going to get a pass, courtesy of Capitol Hill. And we start there, of course, where Lizzie O'Leary begins our coverage. Lizzie?
Well, Betty, we talk a lot about the size and scope of this market. In the second quarter, it was $203 trillion. So that's what we're talking about here. And regulators want to do two things. They want to cut down on systemic risk. They don't want another AIG. And they want to increase transparency. Now, that could hit Wall Street's trading income because pricing of trades would be a lot more transparent here. It takes away a revenue stream. So here's what the regulators want to do. Under this draft bill, the House panel will begin debating today. Most common kinds of over-the-counter derivatives would either have to be traded on an exchange or cleared through a central platform. That would increase collateral as well. Now, we're also going to see a banning of so-called abusive swaps that have a systemic risk component to them. The SEC and the CFTC would both be able to. They'd have the authority to set position limits, and they'd be able to make aggregate data on trading volumes public.
The financial system failed America. The regulatory system failed as well, but the financial system failed. So what we are talking about is a bold change.
Now, it's not really a bold change, though, for some companies. There's an exception for so-called end users. That's companies like, say, Caterpillar or Delta. They carve out an exception for non-financials who use very specific derivatives to hedge their risks. Now, that has led some folks, even Henry Hu at the SEC in his testimony today, to say there are gaps in this regulatory scheme because if you can create a very specific derivative, well, that doesn't necessarily fall under this new regulatory scheme, Betty.
Okay, and tell us, though, that what is a non-standardized derivative, a term that's been thrown around?
Yeah, and this is a really tough question because there are so many things that could fall into this category. I asked a senior Treasury official about this, and he brought up the old Justice Potter Stewart line about pornography to make an analogy. He said, listen, I can't necessarily give you the definition, but we know it when we see it, Betty.
Okay. All right, Lizzie, thank you. Well, we keep hearing from lawmakers and lobbyists how derivatives regulation will be a blow to Wall Street, and Eric Schatzker's been looking at just how big a blow is that going to be?
Well, Betty, it is so important not just to listen to the rhetoric, right, to actually get down to the numbers. And fortunately, we do have some numbers. They're published every quarter by the Office of the Comptroller of the Currency, the OCC. JP Morgan gets more revenue from derivatives trading than any other U.S. bank, about $5 billion in the first half of this year alone. That's equivalent to 40% of JP Morgan's total revenue from trading. Goldman Sachs, number 2 at about $3 billion, followed by Bank of America, and Citigroup there at $1.25. HSBC and Wells Fargo also are players in the derivatives market, though on a smaller scale. It's worth emphasizing these figures are only for U.S. commercial banks and trust companies that report to federal regulators. They don't include foreign operations, so the data may actually understate the importance of derivatives to these banks. Here's one reason to think so. The OCC also provides us with figures on the total value of derivatives contracts held by these regulated entities, as well as the total value at the holding company level. And as you can see right here, there's some big discrepancies at Bank of America and Morgan Stanley. In particular, Morgan Stanley, it's a discrepancy of some $40 trillion. Now, Betty, worth pointing out that if they regulate the derivatives market, all that trading revenue isn't going to go away. That's just what's at stake for these firms, something shareholders need to keep in mind.
And what have you heard, Eric, from how the banks are pushing back on this derivatives regulation? I mean, what have they been saying or lobbying to Washington in order to make this more favorable for them?
Well, initially, the banks pushed back quite hard. In fact, we were just talking to Arthur Levitt, the former SEC chairman, about this downstairs. Lately, though, Barney Frank's proposals watered down, effectively, the Obama administration's plan. And Morgan Stanley told us, or at least made a public statement yesterday, that they consider that a significant improvement. The argument that the banks are making is that you do need to preserve what Lizzie was talking about, the ability to hedge risk. Now, keep in mind, though, if a company like Cargill or an airline or an oil producer wants to hedge risk by buying derivatives, who's going to take the other side of that trade? It's likely to be a Wall Street firm. And if the trade goes in the Wall Street firm's favor, that translates into more derivatives trading revenue.
Right, but then, of course, if it's used as a natural hedge, then there again goes, whether or not the regulation.
It depends on which way the market goes. And, of course, you can re-hedge your hedge.
Right.
So, in the end, it could net out in different ways. It's a complicated subject.
Very complicated, and we're going to be taking a look more at that. Thanks so much, Eric. In fact, in about 5 minutes' time, I'm going to be joined by Bill O'Neill. He's pro-markets, but he thinks some government intervention is inevitable. We're going to get him to weigh in on the great regulation debate. Well, coming up, why former Republican Congressman Tom DeLay won't be a winner on ABC's Dancing with the Stars, but talk show host Rush Limbaugh might be a winner. He wants a piece of the St. Louis Rams, and we'll have more coming up in sports.